Ever wondered why JP Morgan CEO Jamie Dimon is expressing concerns about the future of the U.S. economy? Today, we're diving into the concerns echoing from Wall Street as we explore why JP Morgan CEO Jamie Dimon is afraid of the future of the U.S. economy. Join us in dissecting the insights and apprehensions of one of the world's key financial figures. From economic indicators to global uncertainties, we'll navigate the factors that contribute to Jamie Dimon's apprehensions. Jamie Dimon has led banking giant JP Morgan Chase as chairman and CEO since 2005, steering it through economic ups and downs. In a recent interview, he discussed JP Morgan's growth, his thoughts on succession planning, the economic outlook, and perspectives on regulation, inflation, and Bitcoin. Dimon provides an insider perspective on challenges facing the banking industry and larger macroeconomic crosscurrents that will shape markets ahead. Let's analyze his forward-looking insights and leadership philosophy. Why has Jamie Dimon been able to achieve such consistent success leading JP Morgan Chase through varying conditions over 17+ years at the helm? A growing number of prominent brands across industries like fashion, luxury goods, consumer products, and electronics have decided to stop selling on Amazon. Companies as diverse as Birkenstock shoes, luxury beauty brand Shanghai, Hallmark greeting cards, and Yeti coolers have all left the platform after years of presence. Their departure signifies deeper issues with Amazon's marketplace structure that conflict with positioning premium brands rely on to justify higher pricing tiers. Specifically, the constant downward price pressure exerted through discounts and unauthorized third-party sellers damages the cultivated air of exclusivity and prestige. When customers become conditioned to only purchasing discounted or waiting for the next coupon code, it actively erodes perceived brand value. Companies lose control over pricing integrity, which supports their quality promises. Promotional sales also undermine sustained margins for wholesale partners like department stores, straining relations with once stable retail channels. Beyond pricing headaches, the rampant counterfeiting present on Amazon confuses customers, while diminishing brand reputations built on patented designs and signature materials. Despite brand registry tools, copycat products employing cheap substitutions run rampant and evade detection. The sheer volume of unauthorized third-party sellers also hijacks the customer experience with different packaging, expired products, improper fulfillment methods, and non-existent support. Brands cannot manage such variables nor the direct costs of returns and complaints generated. Yet brands must mitigate the collateral damage of faulty merchandise and seller deception eroding Amazon reviews. Ultimately, brands lose all quality control despite shouldering blame for customer grievances. The common theme across beauty companies, apparel labels, and consumer brands fleeing Amazon is regaining control over their brand presentation and consumer perceptions cultivated through decades of marketing investments. For companies anchored on premium quality and positioning rather than mass market reach, the platform visibility and sales spikes no longer offset the incremental brand integrity risks amplified by Amazon's structure and incentives. How does Dimon view the current economic landscape, including recession risk, the Fed's rate hikes, inflation, and geopolitical turmoil? JP Morgan Chase CEO Jamie Dimon sees a high likelihood of a mild recession in the United States by the end of 2023. In his annual letter to shareholders, Dimon explained his sober outlook stems from fiscal tailwinds that boosted economic strength in 2022, which is now fading rapidly. He believes the consumer savings cushion accumulated during the pandemic from massive stimulus spending will substantially deplete this year. This erosion of buffer funds could expose hidden weaknesses in the economy. Dimon thinks the full brunt of the Federal Reserve's rapid interest rate hikes and quantitative tightening have yet to impact markets and spending. He warns the effects could severely stress bond markets and trigger increased market volatility. Consumer demand may also take a hit as borrowing costs mount. Geopolitically, Dimon raised alarms over threats to Western freedoms not witnessed for decades. He views Russia's invasion of Ukraine as triggering increased global militarization, energy market turmoil, and inflationary shifts reminiscent of the high prices and Fed rate spikes that spurred stagflation in the 1970s. Combined with massive government spending and yawning federal budget deficits, Dimon believes the risks of a punishing downturn are underestimated. Dimon remains highly skeptical of optimistic outlooks, hoping for a Goldilocks soft landing as the Fed cools inflation. Instead, he envisions scenarios of intense market stress. However, Dimon expresses confidence that JP Morgan Chase's financial strength, risk management, and market leadership position it to navigate even the worst potential volatility scenarios ahead. Overall, Dimon's sober perspective balances strong bank fundamentals with cautious economic guidance. By flagging recession probabilities and potential consumer weakness as fiscal support fades, he makes a case for reasonable planning without alarming warning markets about JP Morgan's stability. Why does Dimon disagree with market expectations for imminent Fed rate cuts and foresee extended higher rates instead? Despite bond markets betting on Fed rate cuts potentially arriving in 2024, Jamie Dimon argues the deep structural shifts re-accelerating inflation will block any policy pivots. He sees massive government deficits, infrastructure stimulus spending, green energy transition costs, and worldwide militarization buildups all pumping extraordinary amounts of money into the global financial system for years. Dimon cautions that assumptions of imminent rate cuts are premature given the full brunt of existing hikes has yet to fully permeate through economies and inflation readings. The lags between adjusting rates and visible impacts likely push out well into 2024 before clarity allows recalibrating policy. Rather than focusing narrowly on forecast models, Dimon emphasizes analyzing actual inflation indicators and component trends. Dimon's conviction that structural inflation headwinds will anchor rates higher reflects his experience governing past volatile cycles. He understands transient components like supply chains can ease temporarily, but the sheer scale of global stimulus distorting economies could take years to neutralize without harsh demand destruction. This precedented outlook balances optimism over JP Morgan's ability to adapt with realism around events escaping quick resolution. Dimon telegraphs that healing deep scar tissue, like labor participation, must run its course. His candor aims to refocus markets on the long view rather than short-term relief rallies. Anchoring rate expectations closer to economic realities helps avoid disorderly repositioning should temporary dips revert higher. Rather than lose optimism, Dimon repeats the need for prudence and patience as the world economy progresses towards equilibrium. There will be promising periods, but sustained normalization remains years off. That truth-telling aims to steady markets, not stoke fears. What are Dimon's main concerns regarding proposed heightened bank capital regulations like Basel III? Dimon feels the newest proposed regulations penalize large U.S. banks disproportionately. He believes requirements like heightened operational risk capital and GSIB buffers put U.S. banks at a disadvantage to European competitors without commensurate benefit. Dimon thinks regulations are devised without fully analyzing economic impacts. He sees unintended consequences like mortgage, small business, and agricultural lending suffering as rules make capital costs unattractive. Dimon also argues overlap between different capital buffers creates redundancy without improving resilience. Overall, he contends new regulatory complexity could backfire by undermining the financial sector's diversity and resilience. As an elder statesman of finance, Jamie Dimon provides sobering insights on brewing volatility and flawed policy assumptions. His pragmatism stems from weathering crises and his willingness to challenge consensus thinking. Dimon's cautious outlook and humility, despite success, exemplify leadership virtues warranting attention. He approaches even divisive issues like Bitcoin regulation with nuance. Dimon epitomizes vigilant guidance, steering institutions through unpredictable waters, both currently roiling markets and always on the horizon. His balanced perspective should inform prudent guidance for the interconnected financial system's overall endurance. With emerging risks abounding, Dimon's wisdom in distilling complex variables into common sense merits reflection. As we conclude our exploration into why JP Morgan CEO Jamie Dimon is expressing concerns about the future of the U.S. economy, the world of finance continues to be a landscape of intrigue and uncertainty. If you found this discussion insightful and thought-provoking, don't forget to hit that like button below and subscribe for more updates on the ever-evolving dynamics of the financial world. Your support fuels our commitment to keeping you informed. Share your thoughts on the U.S. economy in the comments and stay tuned for more deep dives into the complexities of global finance.